Warning, this video and all other videos on this channel are for entertainment purposes only. The content of this video and all other videos on this channel are the opinions of the creator only and do not constitute legal, trading, investment, or financial advice of any kind. Investing carries a high level of risk and the majority of retail clients lose money. Do not invest in capital unless you understand the risks and you are prepared to lose it all. Alright, hello and welcome to Camel Finance. I'm your boy Camel, and today is the weekend's deep dive. So what we like to do on the weekend is recap on the base case hypothesis, the primary expectations of the channel. We like to check in and see if things are still going according to plan. If they're not, I want to know about that immediately so that I can look at the data, so that I can perform a reassessment. And if everything is going according to plan, then happy days, right? Long and strong, and we'll see what can happen going forward. So as always, on the weekend's deep dive, we're going to start from the beginning, just in case you're new here. The primary idea for the stock market was that at the lows, we were too bearish and that we were going to have some big blow off top to new all-time highs, followed by a global recession and a deflationary bust. The primary idea of mine for Bitcoin was that we were also too bearish at the lows, and this cycle would likely top before November of 2024, November of this year, qualifying it as a left-translated cycle top pertaining to the 4-year cycle measured bear market low to bear market low. When we fast forward to today, the stock market is largely completing what I believe to be its blow-off top move. And Bitcoin, I believe, is thinking about continuing its move to the upside. If it does indeed continue to move to the upside, then it will have all the familiar hallmarks and characteristics of a left-translated cycle. This whole idea was formed for a number of reasons. We are at what I believe is the end of the multi-decade cycles, and in the more immediate term, when we zoom in a little bit more, we have just come off the back of a highly inflationary environment. When we experience highly inflationary environments, the pendulum tends to swing back the other way, and in doing so, usually ends up in a short period of deflation. When we were towards the lows, I was suggesting that we were about to enter what is termed as the Goldilocks zone. The Goldilocks zone is where things don't look so bad. From inside the Goldilocks zone, it appears that inflation is coming down. We're probably closer to the end of the rate hiking cycle than the start of it. And it is in that Goldilocks zone that the market tends to rally. Another analogy I used to use all the time when we were back down at the lows was when you go from boiling hot to freezing cold, there is a period in the middle somewhere where it is comfortable. And so we have been closely following the inflation data, we've been closely tracking it, and despite of late there being a market consensus that inflation is sticky, that inflation is not going anywhere anytime soon, and that there is no chance of any rate cuts showing up in the next few months at all, I have been making the case that because we are in the middle of swinging from that highly inflationary towards deflationary environment, we will continue to see inflation and CPI come off. I therefore am expecting to continue to see more disinflation in the not too distant future. And again, I understand that this is not a very popular idea. Most of the reason I expect to see this inflation continue to come off is because I have been suggesting that anything you do to the M2 rate of change shows up in the CPI with around an 18 to 19 month lag. Since we have moved down, wobbled sideways, and then moved down again strongly in M2, I have been suggesting that this will indeed present. It will indeed manifest in the CPI print, and thus we've only so far seen the first leg down, the sideways wobble, and we are yet to see the remainder of this push to the downside in CPI caused as a result of the violent snapback in the rate of change of M2. When we take a look at the CPI, like I said, I understand this is not a very popular idea. The market seems to be absolutely sure of itself that sticky inflation is here, that we may even have to entertain additional rate hikes over the coming months. And I have been making the case that this short-term wobble is indeed nothing more than a short-term wobble. The challenging part of all of this is indeed subjective. For some investors and traders, when they see the first one, maybe two sticky prints, that is enough for them to throw in the towel and say, there you go, that's the bottom. Sticky inflation is here to stay, and if anything, we're likely to see further upticks in inflation. Other traders and investors will be more than willing to give this thing a little bit of wiggle room. And of course, the amount of wiggle room each investor and trader is willing to allow is, again, entirely subjective. For me personally, just as we have the stock market, for example, rip higher and there are pullbacks along the way before the resumption of the primary trend, I have been suggesting that what we're experiencing in here is nothing more than a pullback, a counter-trend wobble before the resumption of the primary trend, which I believe is down. Where this is starting to get increasingly challenging for me personally is how many prints do we allow before I can come to the conclusion that it is no longer reasonable to expect this trend to continue. Like I said, some investors, they see one sticky print, even two sticky prints, and that is enough for them to call permanent sticky inflation and increases. That is enough for them to say they're sure that more hikes are coming in the year. For me personally, I am getting to the point now where I think I've given this thing enough space. If we do not continue to see disinflation in the very near future, then I believe, for me personally, it's going to be getting into that area where it becomes, for me at least, unreasonable to continue to expect this thing to play out. So for now, I still maintain that this is a primary downtrend and therefore we are expecting to see further disinflation. However, I can only really continue with this idea for another month or two. If we continue to see sticky inflation or even a curl back up over the next few prints, then for me personally, based on my subjective analysis and experience in the markets, I will no longer feel comfortable allowing more and more months of sticky inflation whilst maintaining the stance that I expect to see continuation of disinflation before ultimately a short-term slip into deflation. There were, of course, some encouraging signs in the PCE data that came out on Friday. Core PCE was ever so slightly colder. Nothing to write home about, but at least it is not creeping up just yet. This, of course, is the Fed's preferred inflation metric, so we're going to continue to track this. I do still think that this snapback in N2 should present in CPI, but like I said, I am getting to the point now where I can only really consider one or two more sticky prints before I have to hold my hands up and say it no longer has the characteristics of a counter-trend move within the context of a primary downtrend. If we continue to stick for the next couple of months, then I will have to hold my hands up and say I am no longer comfortable maintaining this as a stance. Something else I've been tracking very, very closely is the unemployment. And the unemployment at the hard right edge has been creeping up for many months in a row now, showing all the familiar symptoms of the precursor to a large spike in unemployment. The issue with the large spikes in unemployment is they are synonymous with financially stressed conditions and even recessions. We also have existing home sales in black having fallen off a cliff over the last 12 to 18 months. Historically speaking, this precedes, or I should say leads, spikes in unemployment by around 12 to 18 months. So when we fast forward to today, we have indeed had the sell-off in existing homes, and right on schedule, we are seeing that unemployment rate spike. Again, you'll notice when we get these drawdowns, when we get these existing home sales move sharply to the downside, followed by shortly thereafter, around a year later, the spike in unemployment, it tends to coincide with recessions. So again, unless something changes, right? Unless unemployment starts to suddenly get better, unless existing home sales starts to increase, I think the writing is potentially on the wall to see a recession in the not too distant future. And speaking of recessions, which are of course characterized by a slowdown in growth, followed by negative consecutive quarters of GDP growth. We also had on Thursday the GDP for the US Q1. You can see it came in at 1.3% below the prior readout at 1.6%. The trend is now very clear. 6 months ago, GDP was at 4.9%. 3 months ago, it was at 3.4%. And today, it currently sits at just 1.3%. So growth is seemingly slowing right before our eyes, all at a time where we are seeing the unemployment start to curl up right on schedule pertaining to the existing home sales. And the truth of this GDP data is that without government spending, GDP is actually negative. The cyclical component of real GDP has been decelerating again after rebounding from a brief recession late 2022. The cyclical component, of course, is comprised of residential investment, business equipment investment, and durable goods consumption. Again, you don't have to be a genius to spot the trend. And the cyclical component of real GDP was also revised down massively in Q1 from 2.4% annualized growth rate to just 0.6% annualized growth rate. Again, the writing is seemingly on the wall all at a time when investors and market sentiment seems to be that there is no recession, there is no rate cuts, and inflation is here to stay. So just like I said earlier, where the sticky inflation idea is really not a popular one that is perhaps even less popular is that rate cuts are closer than people are ready for. The market has historically been terrible at trying to forward price what the Fed funds rate is going to do, and you can see that here. Essentially, the market is always wrong in trying to price what the Fed funds rate is going to do next. But again, I suggest to you that the writing is actually on the wall. Okay, we've seen the Swiss central bank cut rates, and we've seen the Swedish central bank amongst some others in Europe. The ECB, last time I showed this, the ECB was widely expected to cut in June, and perhaps even the Bank of England too. And since then, the ECB has come out and said that it does indeed plan to cut interest rates in June. Typically what we see is all of these central banks, they go one at a time, but they don't tend to diverge very much, telling us that if we are indeed going to see the ECB cut next, and perhaps even the Bank of England in June, the Fed is likely going to do so shortly thereafter. And I've also been presenting this, which says that historically speaking, every time the Fed's fund rate in orange crosses above the 2-year yield in green, it paused for a little while before it rolled over, with the Fed funds rate being led lower by the 2-year yield. When the green starts to move down, it typically tells us that the Fed is getting ready to be forced to cut rates. We saw it every other time it occurred right here. And for those of you that know your market history, you'll know that the stock market and risk assets suffered very, very badly. Again, telling us to keep an open mind about potentially seeing these cuts show up a lot sooner than most people are ready for. I completely understand this is not a popular idea, just like inflation is going to continue to come off. Again, not a popular idea. But to that I simply say, tell that to the bond market. This for me is the signal. When the 2-year yield starts to strongly move lower, it tells us that we should be expecting to see the onset of a cutting cycle very, very soon thereafter. It also tells us, based on historical data, that the market can withstand perhaps 1 or even 2 rate cuts before major tops come in for the stock market. If indeed this 2-year yield continues to lead lower, we will be expecting to see the onset of a cutting cycle way sooner than anyone is anticipating. And on top of that, it tells us that we should expect to see a major top in the stock market and risk assets around the same time, perhaps with a wiggle room of around 2 months. So for me, the signal, as I said, is I am looking to see if the US 2-year yield can roll over. You can see last week I made this arbitrary yellow squiggle and was suggesting perhaps we get something like this followed by a rollover. It's gone slightly higher than expected, but if I draw your eyes to this upward sloping red support line, is this not breakdown, retest, possible resumption to the downside? Now it hasn't happened yet, but I will say this. If you're in the camp of people that is sure we're not going to see rate cuts anytime soon, then you really need this 2-year yield to start to creep higher. Because if it doesn't, and if indeed this yellow squiggle of mine plays out, if in fact we get something more like this, okay, and then a breakdown, particularly once we lose this prior low down here, then we'll be able to come back to this chart and it will look an awful lot like this. And again, historically speaking, you know what comes shortly thereafter. So again, I suggest to you that if you're in the camp of people that is sure we're more likely to see hikes than cuts, or in fact that higher for longer is here to stay, like I said, you really need to see this 2-year yield start to continue to move higher. And one of the biggest reasons I am so focused on these rate cuts, like I said earlier, is because historically speaking, the stock market and risk tops within the first 2 rate cuts. And for those of you that have been following me for a long, long time, you know this white text right here, do they cut here, has been at the top of this peak the entire time. Part of the thesis for this run-up was that markets would front-run the onset of that cutting cycle, and then once the cuts begin, we typically see that downside leg occur shortly thereafter. And of course, it's also possible that something breaks. Something could occur at the top, some kind of DDE, a demand-destroying event, some kind of black swan. No, I'm not calling for it. But I'm saying if something were to break at the top, we would see the risk be sold off very quickly. And then we might actually see cuts as a response to that crash. So just because historically speaking, markets will front run the rate cuts, okay, tolerate 1 or 2, like I said, and then roll over. If something were to break up here, if we do indeed get this parabolic blow off top, okay, and a trendline breakdown, and that trendline breakdown is catalyzed by something going bang inside of the system, causing some kind of massive demand-destroying event, causing a huge deleveraging in the system, we will probably see them cut late, okay? They will look at this and go, well, we'll see what we can do. We don't want to cut too soon, okay? We don't want to be too easy on monetary policy. And by then, the stock market may be already well on its way to putting in some serious and nasty downside moves. And of course, this is still to be determined. But as it stands, it is not yet invalidated. As it stands, the only component that's really missing for me is Bitcoin. All it would take from Bitcoin is to get a breakout in the not too distant future to set some kind of third angle. And again, if we were to walk forward a little bit into the future and we've got Bitcoin trading significantly higher against a backdrop of the stock market putting in its blow off top, and we are witnessing the 2-year yield come off strongly, again, the writing will be on the wall. So with all that said, let's get into some charts. Here's the S&P, okay? Looked pretty bad right before close on Friday, and then into the close, we got this huge upside push and ended up closing the week above that prior all-time high. So it speaks to this fractal that I kept pulling from back here. And if we were to do something like this, that would be normal and to be expected. And I would even be, instead of considering holding this second angle for a while, I mean, I'm open to that, but I would also be thinking a third and final blow off top angle is probably coming out of this next daily cycle low. That's at least what the weekly cycles suggest. Since we've gone 1 right translated weekly cycle, 2, 3, we would expect the third one to left translate. So again, I don't want to get too far ahead of myself, but so far, okay, the people that were sweating the volatility in the week, the people that were reaching out and saying, blow off top is invalidated. Well, I mean, that close says otherwise, as far as I can tell. And again, if we pull this fractal from back here and stick it here, really, we are doing nothing out of the ordinary, so far at least. Absolutely huge wick into the close for the NASDAQ. So I even said the day before yesterday, I said, look, people that are sweating the volatility, we can come all the way back down to retest this and then still maintain healthy market structure. We got pretty close. That doesn't mean that what comes next is this necessarily, but it does mean we are getting dangerously close to that daily cycle low. That's where I want to get to full exposure. And as per this weird near vertical red line I've got drawn here, I'm going to be looking for a blow off top angle to come in the not too distant future. The Dow Jones, again, looked pretty bad. I said ordinarily, we would be potentially thinking about closing positions below trend line since we had 1 and 2 daily closes below. Now, this could certainly be breakdown, retest, resumption. It's something I'm going to need to keep an eye on. But to me, this perhaps speaks to a big shakeout before a nice V-shaped recovery. I did say in the week as well, I wouldn't be surprised if we get a V-shaped recovery out of here. Perhaps something like this. Daily cycle low, and then it should be bananas mode. Russell 2K still holding above all critical levels. Okay, what else is there to say about that? And so as you can see, overall, the stock market doesn't look so bad. If we continue to take it one day at a time, we continue to size trades responsibly, manage the risk, not use too much leverage, then it makes it much easier to stomach these swings. Gold, I think, is on the hunt for a daily cycle low. If we're going to form a daily cycle low, it should be any day now. It should be somewhere in this neighborhood, perhaps in the early sessions of next week. If we cannot get a nice strong push and a reversal out of this daily cycle low, if we get something lackluster like this, then it will become unreasonable for me to continue to push those trades. I will say this, in the member section, in the level 3 member section, we've got a couple of gold related mining positions, and both of those look a darn sight better than gold. So that's encouraging. It's encouraging that they're holding above, they're sitting comfortably in profit, and they're not showing any kind of warning signs such as this current gold spot position is. So overall, I take that as a hint that we are about to see a reversal from gold. Again, watching the levels closely. If we do start to get some acceleration, then we want to duck out of this trade. But so far, I think we're right around that window where we should probably expect to see some kind of daily cycle low. We're on day 20, so 22 to 24 would be bang average. The DXY, as you can see at the hard right edge, thinking about breaking down out of this support. So again, it hasn't done it yet. And as I often say, nobody wants this more than me into a 3-year cycle low so that we can scratch this one off, okay? But all the while it's above the support, then it is above the support. Now, at the moment, firing warning signs, we're going to find out. Of course, if we do this, that should be absolutely enormous fuel for a melt up and a blow off top. That should also catalyze the precious metal markets and Bitcoin to rip higher. But I don't think this is a requirement. And as I've said multiple times, all the while we're above support, I do think we could see dollar strength and a kind of dollar milkshake situation play out. So I don't think it's a requirement, but this will certainly throw fuel on the melt up fire. And Bitcoin, still very lackluster, isn't it? Still hasn't decided. The bulls are wrong because we're not breaking out. The bears are wrong because we're not breaking down. So we're just kind of chopping around. So there's really not much more to say about that. But the absolute truth of the matter is no one knows until the market proves us right or wrong. So until such time, we stay long and strong, and we will see what the market can give there. And the last thing I wanted to point out, now that we got some of the major data out the way, is do you notice VIX Crush Friday? They step in and they crush this VIX every single Friday without fail. It started life as a meme, but whether it's a meme or not, whether it's funny or not, it is the reality of the situation. Back below 13 for the VIX, I largely expect this to continue to the downside. And again, all of this would likely occur whilst we see some blow off top in the stock and risk assets in general. Assuming we get to that blow off top, assuming they start to break down, then massive, massive trade for the VIX out of there. But we'll deal with that as and when it shows up. As you can see, taking it one day at a time is the strategy, okay? So far, based on everything I've shown you, it pretty much seems like things are still working and operating within the base case hypothesis. There are certainly no major invalidation levels triggered as of yet. So therefore, I continue to stand with this posture. I continue to maintain that it is right until it is wrong. As I said earlier as well, it seems like unemployment is getting worse. It seems like growth is slowing down. Inflation may or may not be sticky. And as I said earlier as well, it's getting to the point where if we don't start to see continuation of disinflation, I am going to have to hold my hands up and say it's starting to feel unreasonable to stand on this narrative in the face of continued sticky prints. But with that said, it also seems like rate cuts are coming much faster than anyone really is ready for, as per the things that I've shown you today, as per the bond market. And again, I suggest to you that the number one chart all traders can be looking at this current moment in time is the 2-year yield. The 2-year yield should signal the end of this bull market being nigh and imminent rate cuts. So again, I say, if you're one of these people that says, no way, Camel, inflation's here to stay, higher for longer, maybe even a rate hike, where you really need to see that 2-year bond yield rally over the coming weeks. If you are a level 3 member, look out for the members only video I'm about to post for you guys. For everyone else, I hope you're doing well in life. I hope you have a fantastic weekend. And until next time, take care from me. All the best. Cheers. Bye.